Good afternoon, everyone. It's a lovely day in upstate New York. I apologize if the first link that you guys clicked on didn't work. I'm going to do a brief little intro while I give people some time to find the new effective link. As I think some of you know, I'm Jason Bailey with Sheats and Bailey, a law firm here in Syracuse dedicated to servicing contractors, subcontractors in the construction industry. And this is Bob. Go ahead.
Jason. Bob Teska with Powers & Company CPAs. I am the partner in charge of our construction services. I handle clients mostly in New York State, large and small. We serve them all.
So I want to take a moment to thank Tracy and Phil from Northern and Mohawk Valley Builders Exchange for spearheading this. Reached out to us and suggested that this information would be helpful to you guys. All of you, I'm sure, are in the process of experiencing some financial distress associated with this virus, or if you haven't already, you will be. And we're hopeful that the information we're going to provide today will relieve some of that stress from you guys. So I appreciate Phil and Tracy giving us this opportunity to get the information out to their respective members. A practical note, or I should say just a housekeeping note, there is I believe on the right-hand side of the page you're looking at is a link for you guys to be able to send in questions. If you can, send them in as we're going through this stuff. And the administrator here who's behind the camera, Tom, will be texting Bob and I the questions as they come in. So don't think we're rude when we're looking at our phones. We're just seeing texts that you guys are sending, and we'll try to answer them as we're progressing so it's on the information as it's being presented. So with that out of the way, I'm going to turn it over to Bob, and he's put together a PowerPoint presentation that goes through the nuts and bolts of the CARES Act, the PPP program.
All right, so we'll kind of dive into this. Thanks everyone for joining us. Thanks again to Phil and Tracy for having us. And I guess I'd like to say that the CARES Act that was passed last Friday is incredibly beneficial to the economy. In this particular portion, the PPP program, very beneficial to just about any company that's under 500 employees that has been affected in one way or another by this epidemic. And there's very few companies that are going to be in the bucket that would be like, yeah, I don't think we could take advantage of that. I will say that this is the most fluid situation that I've ever been a part of in my professional career. The partners at my firm that have been doing this for a couple decades longer than me, they've never seen anything like this. The guidance we've received has continuously changed from when the law was enacted last Friday and we started reading it Saturday morning. There was guidance issued by the SBA kind of clarifying a few things, coloring the lines, so to speak, on Tuesday. And then last night at 9 o'clock, the SBA dropped about 30 pages more of guidance that retroactively changed some of the guidance they had provided on Tuesday. So there's a couple of slides we're going to go through where the information actually is inaccurate based on what came out last night, and we'll definitely point that out. But it's fluid. Stay tuned. You're going to have to stay tuned into your bank and how they're interpreting this, because in a lot of instances, banks are kind of divvying this up differently. So I guess on the first slide we've got here just the general overview that we're going to go through, your potential loan size. We're going to look at eligible and ineligible loan costs, or payroll costs rather. We'll look at the loan terms and the requirements. We're going to look at how we calculate loan forgiveness, and some general comments and observations just that we made at the firm. And with that, I think we'll move on. We're actually on the right slide there, Tom. I was one behind you, sorry. All right, so when you're looking at this, you've got to keep in mind that there were two main purposes for this being issued into law. The first is they wanted you to be able to retain your employees. They didn't want you to have to lay everybody off and then potentially lose them to another employer. They wanted, when the economy, the switch gets flipped, you guys can head back to your job sites. They wanted your benches full so that you can head back and start working again.
And that's exactly how I've described it. A lot of clients, after I sent out the summary that I put together and then Bob's summary has been circulated, a lot of clients called up and said, hey, I'm not going to have any losses potentially, and or why would they pay me to pay my employees if I could just lay my employees off, and in some cases the employees could get more money. I told them exactly what Bob said. The government wants everyone to retain their employees, so when they say go, you don't have to retrain someone. You don't have to go out and find a new person, train that person as to how you go about your business. They want you to hit the ground running. That's the whole point of this program. Whether you have losses or not is inconsequential. They want you to get this money to pay your people, even if it's to pay them to sit on their couch, right? So that when they say go, everyone is ready to hit the ground running. Sorry, Bob.
No, I appreciate you interjecting. I mean, we were in a very tight labor market. So if the contractor XYZ down the street gets the green light before you, he can go through and get the pick of the litter, and you might lose some of your key guys. So that's the reason one. And then reason two was quite simply, this is a stimulus package. So they want money in people's pockets so that, they can stimulate the economy. They can pay their bills, they can purchase things, and just start that economic engine again. So just looking at this structure, the loan program is 100% federally guaranteed. And what that does is it eliminates the credit risk to the bank. And so that induces them to want to participate in this. That's why you see very broad participation. It's rolling out first to approved SBA lenders. If you have a bank that's not an SBA lender, you aren't going to be able to participate with them. You're going to have to look elsewhere. You could run into a problem there because a lot of banks have said they're only going to serve their current client base.
Correct. And what I've told clients to ask for is call your lender, call your bank, and ask them if they are a certified CARES Act lender. If they say no, then you got to call another bank. You got to have someone that's geared up for this. Some of the big institutions, the really big institutions, the Wells Fargos, the JP Morgan Chases of the world, were really pushing back on this because, one, they were worried about potential liability, and because they weren't making any money on this. But so the point is, call your bank first and find out if they're certified. If not, you may have to open up an account someplace else.
Correct. And then the other thing you can do, they are going to open this up to other SBA lenders, or non-SBA lenders, but it'll probably take a couple weeks. But one other place you can look is non-banks that are participating. And one that I found that comes to mind is Pursuit Lending. It's formerly the NYBDC. They're a non-bank that usually participates with the SBA, finding banks to participate in an SBA loan, but in this case, they're going to participate directly. So the way non-SBA banks are participating is they're actually funding Pursuit with $1 million or $5 million, so they end up with this pool of money that they can then loan out. Their website is pursuitlending.com, so you can check that out. They had some information on it a couple days ago. I haven't checked back, but I do know that they are going to be participating, so that could be an option for people. So in general, one of the big questions is, who's eligible to do this? Mm-hmm. Do you have to suffer economic loss? Do you have to, one of the big questions is, do I have to prove that, my revenue's down, something like that? But the participation criteria is the bar set pretty low on purpose, again, because they want to get money into people's pockets. So, you have to be a business entity that was in existence on February 15th, before February 15th, 2020. Okay, that's going to be a good portion of the people going. It's eligible to small businesses measured by headcounts, 500 and below, 501c3 organizations, and 501c19s. Any of the other 501c organizations, not-for-profits, are excluded from this. So it's important to know how your charter is organized. Individuals operating as sole proprietors, independent contractors, and eligible self-employed individuals, also tribal concerns.
The independent contractors, I noted, I think on the revised application form, Bob, that they, either that or in the guidance, they've changed it up so that everyone who's not an independent contractor can apply as of today or Monday, depending on your bank. And then I think they picked approximately 1 week later for the independent
4/10,
contractors.
yeah.
Okay. So if you're an independent contractor, there is a slight delay for you to apply. April 10th, I think you said, right?
Yep. Yeah. Okay. And they did allocate $350 billion to this program. That wasn't a random number. What they did is they looked at the payrolls of companies with 500 employees or less and did a calculation of 2 months worth of payroll, and that's kind of where they ran into this number. That it's not supposed to run out. But that said, the Treasury has indicated they expect a large subscription rate to this, and they encourage you to apply as soon as possible. All right, so moving on to the next slide here, we're going to look at the loan size and the available uses.
Yep,
there we go. So the loan's determined by your average 12 months worth of payroll. So you come up with an average monthly payroll over 12 months, and you multiply that by 2.5, and that becomes your maximum loan size, limited to $10 million.
And what else? Just a quick comment. I read the statute, and I think Bob has read the statute, that the 12-month window that you're supposed to look at is the 12 months immediately preceding when you receive the loan.
Yep.
We have gotten some conflicting information in talking to certain banks. Initially, one bank told me to use calendar year 2019. Another one has said the middle of February 2020, back 12 months. So check with your bank. Your bank may require something specific, something unique. I read the statute as saying the immediate 12 months preceding when you apply for the loan.
Correct. So we're advising most of our clients, unless their bank says something different, to have to prepare the payroll information from 4/1/2019 through 3/31/20. Again, and the confusion really does come from when the SBA issued their first guidance on Tuesday. They did have a clause in there with the initial sample application that said that most people will use the calendar year 2019 payroll information. So that was the first bit of confusion. The guidance they issued last night actually had, in one spot, it refers to the 12 trailing months. And one spot, it refers to the calendar year.
Okay.
So it's definitely bank by bank. We did talk to one bank this morning that's accepting either or.
Oh, nice. Okay.
So check with your bank.
Yeah. 2 questions came in real quick. I'll have you check one, Bob.
Yeah.
The first one was, does the credit score matter? And I haven't read anything that indicates this credit score matters. No. And someone also asks, I'm a small contractor out of PA, set up as an S Corp. I'm the only employee of the company, and PA won't let me collect unemployment since I'm the owner. Can this program help me? I would say yes.
Yeah.
Absolutely.
I mean, as an S Corp, I'm assuming you're drawing a salary, and so you're going to have wages. So, yeah, without a doubt.
Okay.
All right. So looking at allowable uses of the proceeds. No, we're still on this slide, Tom. We're slow. So allowable uses of your proceeds, it's going to include the eligible payroll costs, which are actually defined on the next slide.
Yep.
Payments of interest on any mortgage. The mortgage has to be in existence prior to 2/15/20.
Correct. Yep.
Rent. It's got to be a real lease. You've got to have a lease agreement. Well, what I mean by that is there's a lot of clients that they have informal month-to-month agreements with the primary shareholder with $1,000 a month, and those kind of deals, handshake deals, aren't going to cut it. It's got to be a formal lease with terms that was in existence prior to 2/15. And then our utility costs.
Yes, and the utilities are specifically defined by the statute to include electric, gas, water, transportation, phone, and internet. So all of those costs are considered utilities for which you can use these loan proceeds to pay without any sort of penalty, and in fact, that portion be forgivable.
And then there is some depending on where you look, it was talk about interest and certain other loan obligations incurred, again, before the covered period of when you get the loan. And then it's silent in other places.
And I've read those provisions. Specifically, it says, as Bob noted, interest on other debt obligations incurred before the covered period. The statute defines covered period. What I have told clients is stay away from that. It's too ambiguous. There's too much of a risk that could be considered an expense that they will not forgive. And as a result, you have to pay back. I would stick to the other bullet points: payroll, payments on interest and mortgage, rent, or utilities.
100% agree. What I would say, and I've been telling clients, is if you're having cash flow issues and you're worried about those other loans, most banks, equipment suppliers that are doing lending, they're offering some sort of forbearance. Where you can get out of interest and principal payments for at least 3 months. I've heard of up to 6. So if cash flow is an issue, I would go back to the lender. Everyone's feeling this. Just about, I actually haven't heard of anyone having an issue getting some sort of relief. Obviously, anything you don't pay is tacked on to the end. But that would be where I would go if I was having issues with other debt. We can flip the slide.
Actually, one quick other note: when we were talking about that 12-month window that you're using for your payroll, there's a special rule for seasonal employers, right? And I'll let you take it over, Bob, since you're more tuned in on this stuff than I am.
Not overly tuned in on that, I'm quite honest with you. But you can use a different date range. You don't have to use the 12 months trailing from the application. You can just use the period 2/15 to 6/30. That way, your average is going to be higher than it would be if you had to spread it over 12 months.
Correct. Okay, we have another question came in. We have a general partnership with 3 active members. We don't collect a paycheck, but rather draw off the business. We don't currently have any employees. Are we eligible?
I'm going to answer this question, and then I'm going to let Jason answer this question. So this is probably one of the areas of the most ambiguity in the whole thing. The bank that our firm applied with, our partners are paid. We're K1 employees, so we're a partnership, so the partners don't have wages. We could apply for the loan for our employees today. Mm-hmm. They told us the partners could apply next Friday individually.
Okay. See, my original interpretation was that the partners or K1 people, right, that are getting draws could potentially apply, but the amount that they could ask for would be capped at $100,000.
See, my initial reading of it was people like myself that are only paid through K1s, no actual salary on a payroll report, we weren't eligible. So this is very gray, and I think honestly it's going to come down to what your bank's going to allow you to do. I think this is one of those areas you might find that your bank says, it's allowable up to $100,000 because I do pay payroll taxes. It's just I pay them at the end of the year.
Correct. So I guess the short answer is we're uncertain because this is so new and everything is so gray. What you could try is applying as on Monday, right? You'd be capped at $100,000. And if they reject it, you could try applying the following Monday as an independent contractor.
Right. And
it can't hurt to try.
Correct. And go from there. I mean, that's really, unfortunately, it's a very gray area.
Yep.
All right. So your eligible and ineligible costs that you can use the proceeds for. Or I'm sorry, to go into the calculation. So it's going to include your compensation, which is going to be wages, salaries, commissions, and then tips if you're like a restaurant, reportable tips.
Yeah. Yeah.
Those are going to show up on your payroll register anyway. Any paid time off like vacation, parental leave, sick time, all that's going to go into the calculation. If you paid a severance agreement, that would go in there. And then group health benefits, including insurance premiums, retirement contributions. So a lot of the buckets that you pay into if you're a prevailing wage contractor, they're going to go into this calculation. And then the payment of state or local unemployment taxes. So we're adding that to the calculation.
And just so we back up and take it from 40,000 feet for a quick second. What we're talking about here, the eligible and ineligible payroll costs, are for calculating the payroll amount, your average monthly payroll amount, which will then be multiplied by 2.5, which will dictate the amount of your loan.
Correct.
Yep.
So the guidance that came out last night, interestingly enough, it leads you to believe that you can actually include now the employer portion of the payroll taxes, so your FICA and Social Security.
Oh, okay.
It defines it in there. The one thing they do say is that you have to back out the period from 2/15 to 3/30. For that period, this is bizarre. So for the period 2/15 to 3/30, you have to back out employee and employer taxes for those 45 days. Okay. But you get to add in
a lot.
Yeah, so that's a huge win, I think. Ineligible payroll costs, again, they have to be subtracted out of your aggregate wage total. Is going to be any wages in excess of $100,000. So if I make $120,000 and Jason makes $220,000, we're going to back out $200,000 or $20,000 of my wages and $120,000 of Jason's.
Let me ask Bob, because actually I don't know. I think that is only wages. That is not combined wages and benefits.
That is how I read it.
Okay, so for a lot of people out there working rate jobs, right? Once you add in their bennies for the year, could be over $100,000. But it's the wages that is the $100,000 mark. If they make over that via the benefits, that's you can still add those benefits in. So if they make $97,000 in wages and another $45,000 in benefits, both of those numbers are used for this calculation, correct?
That's how I understand it.
Okay.
The second bullet, that's kind of irrelevant based on the guidance from last night. So that's where I was saying you can now include the employer portion, except for that 45-day period, 2/15 to 3/31, 2020. You back out the employee and employer taxes just for that 45 days. Okay. If you're paying anyone outside of the United States, you back that out. And if you had taken advantage of any of the credits available through the law that was enacted a couple weeks ago for the Family First Coronavirus Response Act, that gets backed out. So you aggregate all your costs, back out any subtractions you have. You come up with a pool of compensation. Divide by 12. Becomes your average monthly, multiply by 2.5, that's your max loan value.
That's what you can actually get in loan proceeds. So,
do we have questions in there?
Yep, we do. So the next one up is interest on my mortgage for my personal house that I use an office for, my business included? Whew, that one's tough.
I think the easy answer is no. I think that maybe if you dug into it a little bit, you could make a case for the percentage that you're writing off of your house on your tax return for business use. Maybe that percentage of your mortgage interest.
That would be my best guess as well. But it's a guess.
Right. And then you got to ask yourself, is it worth that kind of exposure for a few bucks?
Is it worth the red flag that it's going to send out? I personally, if it was me making out the application, I would probably not include that, to risk the red flag that it sends up and potentially delaying your application and your loan proceeds. Right. Next one. As a construction contractor, my workers' compensation is based on payroll. Is that considered a payroll expense? My workers' compensation is based on payroll. Got it. Is that considered a payroll expense?
Unfortunately, I don't believe so. I've got that question a lot, but no, that's considered an additional insurance more than it's going to be part of your compensation.
Okay. Is the grants that I keep hearing about separate from this, or does this forgiveness mentioned become rolled into a grant? So I don't know exactly what you're talking about. What you're gonna hear from us later on is, after you get these loan proceeds, if you use them for specific things like payroll, like utilities, like rent or mortgage interest, within the 8-week window after you receive the proceeds, the loan proceeds, and you apply for forgiveness, it will be forgiven. The way the statute is drafted, they actually have a definition within the statute called the expected forgiveness amount. They anticipate that if you use this money the way they ask you to, payroll, rent, utilities, mortgage interest, within an 8-week window after you receive it, and you apply for forgiveness, it will be forgiven. So I hope that answers your question.
Actually, I do believe the grants that we're talking about here are related to the disaster relief loans under the EIDL or the EIDL, depending on who you talk to.
Okay.
You can apply for these disaster relief loans. It's under the SBA 7A program. And after you apply, it's kind of simultaneous. You apply, and then you click a button for I want this grant, and it's a $10,000 advance that you receive in 3 days that doesn't have to be paid back regardless if you get the loan or not.
Whether you get this loan or not.
Whether you get the disaster relief loan that the grant's attached to.
Gotcha. Okay.
However, there are timing issues associated with one of those disaster relief loans in this PPP loan. Because one of the boxes you have to check on the application is, do you have any other existing SBA loan applications out there? If you have already received the proceeds from one of those EIDL loans, you can refinance it into this PPP loan. But the timing of it is you can't have 2 existing applications, as I understand it, and you can't submit the same expenses for both one, and they both kind of cover the same thing. The EIDL loan's has a little more working capital in it, where you can pay principal and like payables and stuff with it. So the timing of going after both loans is it's very important if you're going to try and do that.
Okay. Last question I have so far is, what determines seasonal employees? I don't think the statute actually defines seasonal employees in a traditional definition section. I think they're giving employers the option for themselves to identify as seasonal or not. We all know that there's this ramp up period, especially in New York, and probably more so in Northern than, say, Central or the Southern tier. So if you think you're considered a seasonal employee, then you can use a specific date set from February 15th, 2019 and June 30th, 2019 to measure your average payroll, because the government recognized if we force you to use a calendar year or a full year, right? The seasonal employee or the seasonal employers are going to get hammered because their average payroll is going to be diminished significantly by the months that they're not working.
Right.
So that's a really long-winded way of saying I don't think the statute specifically defines it. If you consider yourself a seasonal employee, then use the 2/15/2019 through 6/30/2019 to measure your average monthly payroll.
Right. I think it comes down to what date period gives you the largest loan.
Exactly.
And
that's a better way to put it.
Yeah, and if that works for you, the shorter date period, use that date period.
Okay. 2 more questions have popped in. If you have chose not to file your 2019 taxes, as you will have a payment, can you use your 2018 Schedule K to determine eligibility? That's definitely a tax question.
So this is where we get back into the Schedule K piece and what is going to be allowed. And they haven't defined what kind of support they're going to want for that. So my thought has always been bank statements are going to work.
Okay.
Because what are you going to do with a sole proprietor, right? I mean, they don't get a K-1. They have a bank statement that shows deposits. Mm-hmm. They show ins and outs. And so I don't think the tax return is going to be necessary. I think that your bank statements and seeing the direct deposits would do it. Again, not defined anywhere. My feeling based on reading of the rest of the law.
Okay. Someone asked again, what was the formula to figure the loan amount? Real simple. It's your average monthly payroll for the 12 months preceding your loan application. Unless you're a seasonal employee, then you use 2/15/2019 through 6/30/2019. So it's your average monthly payroll for the 12 months preceding your loan application, multiplied by 2.5. And the average monthly payroll can include things like wages, compensation, salaries, vacation time, 401k contributions made by the employer, profit sharing contributions made by the employer.
Right. This is all employer stuff. It's not the employee withholding or deferrals. Only the employer.
Correct. State and local taxes state and local taxes paid by the employer, but not FICA. But as Bob said, the guidance that just came out Wednesday night makes that a little bit more ambiguous and seems to say that maybe we can include FICA. So again, take those expenses for your 12 months, or if you're seasonal, that 6 month window, and figure out your average monthly payroll cost, multiply that by 2.5, and that dictates the amount of your loan.
All right, let's flip the slide. All right, so we're going to look at loan terms and requirements. The new application is out. They did issue a new application last night. It's 2 pages, just like the original version that came out. And it really comes down to the top third of the first page has got some financial information in it. And then the rest of the application are yes/no type questions. So you have to make good faith certifications that your business has been affected by this. There isn't a measurement for this. So if you think about it, unless you're a grocery store, you've been affected by this in some way. Even businesses that are considered essential, like, sorry, but attorneys weren't, but accountants were. Most of our staff, 80-85%, is working from home. We are not as efficient as we were.
Of course
Things
not.
are taking longer. People are not working the same way. We've been affected by it. You guys have certainly been affected by it. Contractors have certainly been affected. Even if you have jobs that are still working, now you're working through, I've got to be 6 feet away. In fact, we probably should be 6 feet away from each other. Camera won't get us in the lens then. You've been affected by this. Grocery stores are about the only, the only type of enterprise that I can think of. I have some trucking clients. They said, yeah, we're essential, but half of my deliveries used to be to commercial enterprises that are shut down.
Sure.
So I can't think of a company that hasn't been affected somehow. You have to certify that the funds are going to be used for the qualified expenditures. You can't get the funds and go to Hawaii, even if that was an option. And one of the things you certify to is there's no pending other SBA applications out there. You do that, you're good to go. You do the calculation. There's going to be very little underwriting on this. They're going to probably look at like your payroll reports, your New York 45s for certain information. Again, bank specific, but it's not your traditional bank underwriting here.
And someone I spoke to this morning had a good idea that I wanted to relay to everyone. He inquired, how's the logistics of this going to happen? In other words, when you upload your application, because obviously you can't go in physically and hand this to everyone, right? You're going to upload this to most banks, I suspect. We don't know if they're going to have specific places to upload proof of payroll, then proof of 401k contributions. We don't know. So what I would suggest is upload everything in one PDF. So that eliminates the possibility that a PDF doesn't get uploaded or something gets misplaced. Put it all as one package. If they also want you to break it out for their convenience, but I would suggest upload every one of your pieces of paper that you're using to support your application as one PDF and upload that.
Man, that was worth the price of admission right there.
There you go. It might prevent them from missing something or telling you that something didn't upload and then it delays your application. That's what we want to try to avoid.
Yeah.
A few more questions have come in. So it says, similar to the house mortgage interest question, it says, what about payments on a personal truck that I use for my business that my business pays for? Also the insurance for this vehicle.
So no principal payments of any sort are qualified expenditures. And the interest on that, again, I think that would be questionable. I would strongly suggest calling the lender and see if you can get relief from principal and interest payments for a period of time.
And I know what you're probably thinking. Under utilities, transportation is listed in the statute as a utility cost. Unfortunately, the word transportation isn't defined. But I agree with Bob that they don't want you to use this money to necessarily pay for principal payments on hard assets.
Correct. And you can't prepay items. So, I'm gonna prepay 6 months of rent. You can't do that. It's got to be what's currently due.
Yep. Next question. Can you calculate your business liability insurance?
No, that can't be part of the calculation.
Okay.
Only health insurance.
Next question. As a painting contractor, what if we don't have enough work to call back all of our employees by June 30th, 2020? Can we still get our loan forgiven? So here's how I've answered this to clients. If you don't pay them, then your likelihood of then the amount that gets forgiven will be reduced. So it's, in my opinion, it's irrelevant whether you call them physically back to work, as long as you're paying them. And I understand now what you're probably asking. Well, why would I pay them to sit home and do nothing? You're paying them because the amount of money is being given to you by the government and being forgiven. Again, going back to our earlier comments, the government wants you, once they say go, to be able to hit the ground running, have these employees ready to go immediately, not have to search for new employees because you laid someone off and that employee found a contractor that had work that was deemed essential and has been working for the last 4 weeks. So what I would say is, even if you can't call them physically back to work because you have no work, I would suggest putting them on the payroll, because that increases the likelihood and the amount of money that will be forgiven.
Correct.
Okay.
I agree with that.
Next question. If I look at applying for a PP loan and the grant which I should apply for first, if you are talking about the time... Oh, I think you're asking, if you're applying for the loan and the grant, which should they apply for first?
So I think at this point, you would apply for the PPP now, and then when the proceeds are used up, which should be relatively quickly, then apply for the grant. If you had applied for the EIDL loan previously, then and you already had the proceeds, you could roll it into this. But I don't believe from a timing standpoint, you're going to have time to apply for the EIDL loan, get proceeds, and then there still be funding available for PPP. So I'm encouraging people, since this is an easier application and easier underwriting, go for this first, use the proceeds, because this is only available through June 30th or until funding runs out, whereas the EIDL loans are available through the end of the year.
Okay. Next question that came in, and it's the last question we have for right now. I'm an officer in 2 separate S-Corps. I'm the only common officer or employee. Will both corps be eligible for PPP? And then parentheses, you've asked, since I draw a paycheck from both companies. I'm the only common officer or employee. Will both corps be eligible for PPP? I would say probably yes, but if you look at the application, there's a reference on there to if any of the owners of a particular entity have ownership in any other companies. They're trying to make sure they're not paying for the same work twice.
Right.
So could you put in for this? Yes, I would say. But if you put in and say you worked 40 hours for both companies, that's going to raise a red flag. I would advise against doing that. Right? If you're working 20 hours for one corp and 20 hours for another, then apply for both. There's nothing wrong with that.
Right. I would agree.
Okay.
So looking at the loans a little more, these loans have no personal guarantee. There's no fee paid by the borrower. That's paid by the SBA to the bank. So it's really a misnomer that banks say they aren't going to make money off of this.
Oh, okay.
Yeah. And there's no recourse. So they cannot come after you, any shareholder, for this loan. There's complete deferment of the loan for 6 months no payment, no interest. And the idea there is within that time period, you're going to use the proceeds so that they should be forgiven. And if you end up with an amount that's not forgiven and it does term out, it's the current guidance, what came out last night.
So if you're looking at this slide on your screen, this last line has been modified.
Correct. So that was the guidance from like Tuesday. What came out last night, it's going to be a loan of 2 years with an interest rate of 1%.
And that is only on the amounts that are not forgiven. So
Correct.
Going back to what I said earlier, if you apply for these, get these proceeds, use them for payroll expenses, use them for rent or mortgage interest, use them for utility expenses within the 8-week window after you get them.
That's key.
That's key. They will be forgiven. If you don't use 100% within that 8-week period, so let's say you get a loan for 100, right? And you use 80 within those 8 weeks. 80 of it is forgiven, provided you apply for forgiveness. The 20 then gets turned into a loan that needs to be paid back within 2 years at 1% interest?
1% interest.
1% interest.
As of last night,
Yes.
9 o'clock.
Yep.
Subject to change. And we haven't mentioned it yet. We're going to go to the next slide. We haven't mentioned it yet.
Thanks, Tom.
But these loans, once they're forgiven, the craziest part about this is it's 100% tax-free. Typically, when you have debt forgiveness, it shows up on your income tax return as ordinary income, and it's going to be taxed at ordinary rates. This is like the debt's canceled, never happened, no taxability to it.
So that's from a federal standpoint. How does New York take a different stance, or don't we know?
That's interesting. No one's asked that question, but I have to imagine New York's going to follow along with that.
Okay.
They've kind of been tongue and groove with everything else.
Okay. Okay.
All right, so we're going to look at here how the loan's forgiven, the loan forgiveness calculation, and I do have a couple slides where we actually put some numbers to paper because I'm an accountant and I needed a spreadsheet in here somewhere. But we'll go through, and that'll kind of make this make a little more sense. At least it does to me. Mm-hmm. So your loan value that's forgiven, it's a two-pronged test. And the first thing they look at is your qualified expenditures. So we have our loan value, and then they start measuring it. If I got my loan today, I applied, and miraculously it got through, and I got my wire back, and it's deposited into my account. The clock starts from today, 60 days forward. I've got to spend those proceeds, and I can't go on a shopping spree. I have to spend them on the qualified expenditures, which is, again, going to include the same payroll costs that went into the calculation. So the wages, the retirement, the healthcare, so all those same costs. But then I get the added bump where I can use the qualified expenditures for rent, interest on the existing mortgages, and then the utility payments that you had talked about.
Yeah. So
I have 60 days to spend the loan proceeds on the qualified expenditures. If I do that, I'm past step one. If I kind of get through that and I'm left with $10,000, well, that $10,000 isn't going to be forgiven. Okay, and so that's going to end up being termed out. And then the second part of the test is an employee test. And they're looking at a head count because, again, one of the primary goals here is they wanted to keep these people on your bench, on your payroll, so you're good to go. So they're going to look at your employee head count at a period before you got the loan, before the pandemic hit, to the 60 day, and compare that to the employee head count to the 60 days after you received the loan. And if it's a 1-to-1 ratio, 100% of the proceeds are forgiven. If it's a 85% ratio where you lost 15% of your employees, only 85% of the loan proceeds would be forgiven. The remainder would be termed out.
And it's important, if you look at the slide, hopefully it's on your screen, where you get to, when you're comparing during that 8-week window, the number of employees you had to the previous window to see if you've maintained that, you get to pick
Correct.
One of two windows. So you get, like Bob said before, you get to pick the more beneficial window. So you get to pick between how many employees did you employ between February 15th, 2019 and June 30th, 2019, or the number of employees you had on your payroll January 1st, 2020 and February 29th, 2020. So pick the period that best matches the number of employees you're going to have in the 8-week window after you get the loan proceeds.
Or actually, you would pick the period that has the least amount of headcount.
There you go.
And it's measured by full-time equivalents in this case. So 2 20-hour-a-week guys are 1 full-time equivalent. So you just want to pick the period where you had the lowest headcount is what it comes down to. All right, so let's flip the slide and we'll go through our first example here.
Before we jump into that, one question.
Yeah.
Question came in from the audience. If we had 20 employees prior to April 3rd and are now operating with a diminished crew, which payroll amount would need to be satisfied to have the loan forgiven? So I'm unclear about the question. But your reference to a diminished crew, what I would say is, I'm going to echo something we've said a couple times already. Even if you can't physically bring those people back on to perform work, put them back on your payroll right before you apply for the loan.
Or at any point, so if you have people laid off and you bring them back at any point during the 60-day window, anyone that was laid off that comes back is said to be counted as if they were there the whole time.
Okay.
The problem with that is because we're like, oh, I'll bring them back on the
last
50th day. Yeah, they would count, but you wouldn't have the payroll cost to use up all the proceeds.
Exactly.
So it's going to behoove you to bring them back right after you get the loan proceeds.
Yeah, exactly. So that's why I'm saying bring people back on the payroll, right? Because then you reduce your risk of losing them, and it won't cost you anything.
Right.
Because you're simply going to take the money the bank is giving you, and you're going to hand a portion of it to your employees. You're going to keep your employees happy because they got a check for 100%, and in some cases not have to do anything for it. And then as long as you paid them in that 8-week window after you get the money, it's going to be forgiven. So you don't lose anything for bringing them back on the payroll.
Right. Yeah. And in most of my guys are looking at this as it's defense, right? You're keeping guys on your payroll so contractor XYZ doesn't pick them up.
Exactly.
And so it's a defensive posture.
Yep.
All right. So looking at the example here, so you've got the use of the proceeds test. So we had loan proceeds in the example of $1 million. And then we had qualified expenditures over the next 60 days. We had wages, we had our health insurance, we had retirement, rent, and utilities. So I spent a shade over $1 million in qualified expenditures. So I passed the first prong of the test there. I've used my proceeds all on qualified expenditures. Then I look at my headcount test, and my equivalents my full-time equivalents during the 60 days after receiving the funds is 100. And then I get to pick whatever one's most beneficial to me from the 2 time periods below. In this case, it's February to the June time period where I also had 100. So I have a 1-to-1 ratio, and I've spent all my proceeds. So my loan in this case is 100% forgiven. It's tax-free, and I'm golden. All right, so I wasn't so lucky in the next one. So in the next slide, we've got, again, the use of proceeds is going to go first. And we have $1 million of proceeds. And same thing, I was able to spend all my proceeds here. So I was good there. The problem I ran into was in my headcount test. So for the 60 days after, I had a couple guys that were just scared to come back. They wanted to, stay in their house and not potentially be, exposed to the virus. So my headcount's at 93. But my lowest head count in the 2 qualified periods is 100. So we do 93 divided by the 100. And so I've only got a ratio of 93, or 93%. So in this case, 93% of my proceeds, or 93% is going to be forgiven. So I passed the first test, the proceeds, but I didn't quite get over the hurdle for the headcount test. So 70,000 of those proceeds are going to end up in a loan, which would actually be 2 years at 1% interest, according to last night.
And just so I know, this is a lot of information in a short period of time. We have been trying to digest this for a couple of days with guidance constantly changing thing, and certainly guidance from the state and ESD changing what construction can be performed and where it can be performed. But I just want to, while this slide is up, point something out. If it isn't clear, if it hasn't been clear from us already, when you apply for the loan, you do not include in your calculation your rent cost, your utility cost, your mortgage interest cost. You don't include that in the calculation for the loan proceeds. That the calculation for the loan proceeds is based purely on payroll, what you pay in benefits to those employees, 401k, contributions made by the employer, state and local taxes. That goes to the calculation for how much money you're going to get from the bank. However, what you can use that money on is payroll, rent, utilities, mortgage interest. So in one box, they use one way to calculate how much money you're going to get, and they use a different way to calculate what you can spend it on.
Right. So that's what the 0.5's for, right, Jason? So they want you to cover 2 months worth of payroll here. So they could take your average monthly payroll and just multiply it by 2 months of payroll. But they also wanted you to be able to cover some of these fixed costs, and that's what that 0.5 is supposed to cover. So it doesn't go into the calculation per se, but that's what that 0.5 is in the calculation.
Understood.
So I think we're on our next slide. So these are just some thoughts that at the firm that we put our heads together, and this is what kind of shook out. And I think we've covered some of these, but the banks are going to be inundated with requests. I mean, they weren't ready for this. I haven't spoken to one loan officer that's happy currently. Understand that their position is they're a little overwhelmed. That said, it's going to be important to, when you present your information to them, you're giving them what they're asking for. That way, they don't reject it and you have to go to the back of the line again. The fact that this is 100% federally guaranteed, that should mean that, there's a wide swath of banks that aren't going to participate. And then assuming that you can provide the good faith certifications, do not see a downside of this at all. I mean, I can't see why you wouldn't fully participate in this program. To me, it makes nothing but good business sense.
That's right.
As we've said, we suggest contacting your bank. If your bank is not an SBA lender, you can contact some other ones, attempt to, or like I said, that Pursuit Lending, you could reach out to them. And then, as Jason was just talking about, for companies that are shut down or you got guys laid off, you're going to have to time when you bring them back. I've talked to several people this week that have laid people off just in the last couple of days with the full intention that as soon as this loan goes through, they're going to bring them back and get them on their payroll again, because that was the purpose for this program.
In fact, I told one client today, from a timing mechanism, I said, the applications for the most part aren't going to be accepted until Monday. We have no idea if they're going to be able to get you the loan proceeds in a day or in a week. I have no idea. So what I suggested to that client was, the people that you have that are on unemployment right now, that you just laid off, tell them right now that not next week, but the following week, you're bringing them back on the payroll. That gives you an opportunity to submit the application on Monday, give it a few days to actually get the loan proceeds.
Yep.
And then theoretically, you're going to have about 7 to 7.5 weeks to spend it, or having those people on your payroll. If you have them off the payroll next week and bring them back, it would be the week of the 18th or something like that. Yeah.
All right. We have any more questions? I'm pretty sure that's my last slide.
Yep. Some more questions came in. If workers' comp is not covered by the PPP and we pay our people to stay home, will we get a workers' comp invoice based on that payroll cost? Are we to take a loss on workers' comp cost?
Not an insurance guy, but you're paying wages, so I would assume that the same workers' comp piece you would have to pay. However, you got to remember there's funding available to cover your other overhead type costs. So you're not going to be spending the money you would have been spending on rent to keep your lights on and those things. You're going to have extra that you can then pay your workers' comp with.
Next question. Also, if we have seasonal employees for 1 or 2 weeks during either time period, before or after the loan, are they to be added to the total employee headcount even if they were temporary?
So when you apply for the loan, it's a head count. It's not full-time equivalents. So it's how many employees do you have head count. When they're measuring for the ratio for how much of the loan is going to be forgiveness, that's a full-time equivalent based on the periods that you choose.
Okay. Next question. If you haven't used the full amount of the proceeds, I would guess that you can use the unused balance to repay the balance on the loan.
Yes.
So as not to incur interest expense, yes or no? Yes.
Absolutely.
But here's what I would say. Let's say, I'm just going to pick random numbers. Let's say you get a loan under this program for $500,000. You use 350 of it during that 8-week period of time, and that's forgiven, and you have 150 left over. If you have other debt that's at a higher interest rate than 1%, which I suspect you do, consider applying that portion to other higher interest debt, unless it's going to, you can't pay it off within the 2-year window. If
Correct.
you don't
That's
think,
the kicker.
If you don't think you can pay it off in the 2-year window, then don't do that, right? Use what the questioner asked, which is simply pay it back before interest starts accruing.
Yep.
And then next question, are we figuring only 2 months of salary times 2.5? No, I think I understand your question. You're taking your average monthly salary and multiplying that by 2.5, not taking 2 months of salary
But
times 2.5.
remember, it's not just wages.
Correct. Oh, sorry.
Yeah.
Two months of payroll expenses.
Right.
Yep.
So you add in the health insurance, retirement, the state unemployment taxes, becomes an aggregate number, divide by 12, multiply by 2.5.
Correct. So I'm going to make a comment here in a second. In the meantime, get your pens or pencils ready, or ability to type something out. We're going to give our email addresses because
I thought we were giving away a prize or something.
No. What I'm going to say is, to the extent you have questions after we end this webinar, over the weekend, next week, it doesn't matter. Either email Bob and myself directly, or email Tracy at Mohawk Valley or Phil at Northern New York, and they'll pass on your question. And I'll do my best to get back to you within 24 to 48 hours. There's a lot of stuff going on right now, but I'll do my best to get back to you. My email address is the letter J, my last name, Bailey, B as in boy, AILEY, at theconstructionlaw.com.
Mouthful.
Yeah.
My email address is rmt@bcpllc.com.
And if you can't get it down, or if you didn't hear us clearly, just contact Phil or Tracy. They're the ones that really wanted us to get this information out to their members, to help you guys. So they'll be more than happy to pass along our contact information, or simply just pass along your questions if you want them answered anonymously.
And I would also say that if you have good feedback, send that to me. Anything negative, send it to Jason.
I don't see any more questions coming in, guys. So I think we will wrap it up. Hopefully you find this useful. Hopefully you all apply. Again, don't think you have to have losses to apply for
Correct.
us. Apply and get the proceeds. Use them so you're not taking the financial hit. You know, at the end of the day,